Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Relations here at PassiveInvesting.com. And with us today, we have Will Matheson. Will, welcome back to the show.
Thank you for having me again.
Yeah, well, before we dive into your latest deal that just closed here in August, Summers Run 112 units in Asheboro, North Carolina. Tell us a little bit about yourself, how you got into real estate, and where you are at today in the multifamily space.
So yes, I work at Matheson Capital, the very clever name, with my twin brother. We co-founded the company together. Before doing that, we were brokers in real estate at Marcus and Millichap out of the Raleigh office. And we really said, brokerage is great, but we really want to get into the ownership side. So we started first acquisition 2018, literally buying a duplex about as small as you could possibly do. And I think we're 14 acquisitions in at this point, seven of which we've sold. So we've gone full cycle seven times and just been scaling up over and over and over again. One thing I always say is I always joke with people that, where we are today, we feel pretty lucky. We sold most of our portfolio in Q4 of 21, Q1 of 22. We don't really have floating rate debt exposure as the lead sponsor on any deal, so our investors are happy, and we think now's a pretty good time to buy. So we're very actively looking.
Awesome. Well, let's dive in on your latest acquisition. Summers Run, 112 units, Asheboro, North Carolina. When did you close and what was the purchase price?
So we closed on that property in August of 2023. We paid $16.3 million, which is about 145-ish per unit. It's 96/2006, 2007 construction, great assumption loan, 3.32% with over 3 years of IO remaining at the time of the purchase. So it had a lot of appealing fundamentals that we really jumped at.
Awesome. Well, I look forward to getting into the loan assumption details because before the show, you and I were talking that wasn't exactly the smoothest process. But before we get into there, let's talk about what was appealing about this deal? How did you find it when you saw it? What did you immediately look at as far as part of the business plan?
So a few things jumped out to us immediately. We brought the property through Berkadia's brokerage. They showed it to us originally. And what we really liked about it were a couple of things. One, it was far and away the best cash flowing deal we'd seen since 2019. I mean, you seeing the multifamily world, we all know that things started getting crazy in 2020, getting crazy in 21, 22. Seemingly nothing would cash flow off the bat. This thing, without doing anything, the debt service coverage was like 2.5. Like 2.5 debt service coverage ratio. We could do nothing, and when the amortization kicked in, the debt service coverage ratio would still be 1.5. So we loved the cash flow on the property, very hard to find these days. And we also loved there was a lot of development going on in Randolph County, where Asheboro is located. Randolph County, it's part of the Triad in North Carolina. You have every single time we looked at it, the number went up. When we started, there was this Toyota electric battery plant being built, and the first number we read is 3.5 billion. And every few months, it gets updated. Like now they're investing four, now they're investing 4.4, and by the end of it, because it was an 8-month contract to buy the property, I think it was $5.4 billion investment by Toyota, their largest EV investment in the entire world. Energizer is investing more in Randolph County. Every week we would find some new investment, some industrial investment in Randolph County. And that was really appealing, more jobs, more demand, but very limited new supply of apartment construction. So just the fundamentals really strong, the cash flow really strong. Those are all the reasons we really liked the opportunity.
And what kind of vintage of property is this?
So it was built in two phases around 96, 97, and that's the majority of the property. And there's also some 2006, 2007 involved as well.
Okay. And so when you purchased it through the brokerage, were you the only group looking at it, or were you in competition with other groups?
So There was no call to offer date or anything like that. I did learn it had just fallen out of contract with another buyer, is my understanding, but I don't think we were going through some call to offers. There's three offers on the table, anything like that. Now, that's not to say, I would find out later while we were under contract. Some other brokers had been shopping it, but as you guys know, there is a difference between, hey, check out this deal versus, hey, here's the call to offers, here's best and final next week. It just changes the dynamic a bit.
Hmm. Okay, so how did you structure your deal to, if there were two other offers, being put in, how did you structure your deal to win the deal?
Uh, I mean, we, we did put some non-refundable money down. It's becoming increasingly rare, but we were confident we'd qualify for the loan assumption. And, if that's the only risk you have to take on, we were going to take that risk to raise this money. And yeah, that provided the seller a lot of assurances that we would close. Now, as I mentioned earlier, the contract ended up taking something like 8 months. I joke that it was almost a full pregnancy to get that deal done. So it took a long time. We were really grateful for the seller working with us because the loan assumption process is pretty tough right now. Fannie Mae, Freddie Mac, they're really backed up. Shockingly, there are a lot of loan assumptions given the movements in interest rates.
Mm-hmm, mm-hmm. All right. So when did you decide? Okay, so you see this deal, you put it under contract. When did you decide to go walk the property?
So we visited the property. I don't know, it must have been 4+ times throughout the course of it. At first we see it, the first time we see it, we probably walked it in January or February, um, just to make sure we wanted to buy it. Within the first 30 or so days, we're doing the full unit walkthrough. And then we bring in a JV partner later on while we're in the equity raise. They want to take a big chunk of the equity. So we visit it with them. And then we're just making periodic visits after that again because the process took so long. So we did the full unit walkthrough. Then I want to say the first 30 days of the contract. And we were visiting it again every month, every couple of months, just to make sure things were continuing smoothly.
Okay. And so how did you structure your contract? Was it like a 30-day close? I mean, I'm not going to assume that it was a 90-day close because it took 8 months, but like, how did you structure your contract and what kind of extensions did you put in there?
So I believe we did, I want to say we had a 30-day due diligence and 75 days to to get approved for assuming the loan. And after that, it was going to be either 15 to 30 days beyond that to close the project. Now, obviously, that doesn't add up to 8 months. So we had to work with the seller a couple times because we were just hitting some snags with Fannie Mae, but they were confident that we were going through the process and doing the work, and they didn't want to start over with new loan assumptions. So they were very accommodating on some delays that were outside of our control.
Mm-hmm. And did you have to put down additional hard money in order to, keep it under contract?
Yeah, I think by the end, I think every time we were extending, we were maybe putting another $50,000 down or something like that.
And so what was your all-in hard money on this deal?
I think it topped out around 250,000. I mean,
Okay.
we're recording this a little over a month afterwards, and I can't remember the exact number, which just goes to, you know, after a while, it kind of blends together.
Well, you likened it to delivering a child, which, having being a mother myself, sometimes like the month after delivery, you're just like, I'm just so thankful that I have a healthy child, and I'll forget everything else. So there you go. I understand. Well, let's talk about the physical due diligence. Were there any issues that came up whenever you were going through the due diligence on the property?
During one of our walkthroughs, there was just a giant trench being dug in the property, which we were just like, what is this going on? It had something to do with a cable contract. We were like, is this gonna be like who is doing this? Or we're not paying for this. Is this gonna be done by the time closing is taken care of it? And it was, but that was just we walked on the property and we saw like what is going on? Why is there a trench in the middle of it? Otherwise, no, the property was in really good condition. 90% of it was unrenovated, so that presented a lot of opportunity. The interesting thing about the property was that there's a vacant like 5,500 square foot former office building. I think it used to be a pharmacy or something, just in the middle of the property. Um, and we look at that and we're like, we're not going to turn it into an office building like that. You know, we don't know how long it would take to lease, what the tenant, the capex, or anything like that would be. And it's also kind of weird just to have that. So, for the physical due diligence, we went through this entire planning process of let's turn this into a leasing office because the leasing office is currently in an apartment. Let's turn it into a leasing office. Let's put in some amenities, a package room, a better gym, things like that to elevate the tenant experience. So that was really the only interesting stuff that came up during physical due diligence. The property was in great condition.
Mm. And then what about the financial due diligence on the property? Was there any interesting things uncovered there?
Nothing interesting financially. I mean, you always love to be in a position where month after month the rent roll keeps going up. So that was nice. I want to say it went up, maybe collections went up 4% in the time we were under contract. It might have been more. Every single month it seemed to be getting better, but no, nothing really jumped out financially. Very clean deal, nothing hidden that we could find. Looked great.
Awesome. Well, you know, and sometimes whenever you have deals that run that length of time, 8 months to close, sometimes the property management tends to take their foot off the pedal a little bit as far as like lease up. So that's good. It sounds like you had a good scenario.
Yeah, we were following up on that, but we also we when we changed management, we retained the same maintenance tech, so we had pretty good insight into, hey, is everything moving along smoothly? Like we're not getting backed up on work orders or anything like that. They did have a manager leave while we were under contract, which presented a bit of a jumble at the property, but by and large everything checked out.
Awesome. Well, let's talk about financing the deal. Okay. So it sounded like you had about 100 to 115 days to close. Um, that is well under 8 months. So tell us a little bit about first of all, the financing structure, right? It is an assumable loan. Let's talk about the rate, how much was left on that loan and everything. And then let's talk about like what happened here.
So yeah, the loan, it was about a $10 million loan. There were 8.5 years. I want to say it was originated in, let's say, November of 21. So right about as low as rates could go. And yeah, by the time we close, there's 3 years, 4 year, or 3.5, 3 years, 4 months, something like that of interest only still remaining on the loan, which is phenomenal. People talk about loan assumptions all the time and they say, oh, the rate's really low. Yes, but if it's amortizing, then your loan constant is really high. So it can still make cash flow difficult. But yes, with a really low rate, with a lot of interest only, and then 5 years after the IO period. So there is 8.5 years remaining on this loan. It provided a ton of security for the asset. Yeah, I mean, you were locked in at 3.32% for the next 8.5 years. Pretty good spot to be in. The loan
So
assumption
I'm curious.
process. Yeah, go ahead.
I want to talk about the loan assumption process for sure, but I'm curious if this was such a great deal and such good repair with, income continuing to grow. What was the seller's motivation to sell?
So the seller, as I understand it, had some other assets within their portfolio that did have some floating rate debt exposure that were in a bit of trouble. They weren't really in a position to be sold, so they needed to sell the sellable properties to focus on maybe redirect some cash towards some of the underperforming assets. So it wasn't a distressed, the property itself wasn't distressed, but it's my understanding there was distress elsewhere in their portfolio, and that's what drove them to sell.
Mm, mm. I think we're going to be seeing a lot more of that over the next 12 to 18 months for sure. So
Every month, I see a new property that hits the market that's selling for less than it was bought for in 2021.
ouch. Well, let's talk about this loan assumption. Okay, it seems to be we gotten through the details, but it seems like we haven't gotten through the story.
I mean, the loan assumption process, it's never fun. Um, this was our first loan assumption, but every time I talk to some, grizzled real estate veteran, they tell me that nothing is more annoying than doing a loan assumption. They're just it's back and forth, and it's particularly bad these days just because Fannie Mae and Freddie Mac are so backed up because, you know, people don't want to get new financing if they can help it. They want to assume these loans that have their sub 4%, sub 5% interest rates. So, take your typical full exam that they're going to do, every question that they're going to ask you, and then add in that they've never been busier than ever, or they are busier than ever. And it was a long slog that just took quite a while.
Mm. No rest for the weary here, it sounds like. Well,
No.
let's talk about the capital raise on the deal. So a $10 million loan assumption. So you did say something at the top of the show that you had a JV partner that came in partway through the deal, and then you raised capital on the rest. Tell us, how that all came together.
Yeah, so when we first launched the deal, when we first put it under contract and we're prepping the investment materials, we want to send it out to our investor list. We were planning on doing a full syndication of the property. And as we're going through this process, we're collecting soft commitments, et cetera. We had a group come in, and they offered us about 2/3 of the equity. And I mean, in this environment, a lot of equity is very skittish. You don't turn that down. We told them, look, we have a lot of investors out here. They're really excited about this opportunity. And we had had a deal last fall where we were planning on syndicating it, and a group came in and they offered us all of the equity for that. So we had to tell a lot of our investors, like, hey, you know, unfortunately, we're gonna have to take this opportunity because they're funding the entire project, so we can't syndicate it. We got to do the joint venture. Very disappointing for them, understandably so. So when this opportunity came up, they offered us 2/3 of the money. We were just saying, hey, look, we really appreciate you letting us syndicate the rest of it because I don't want to pull the rug out from under two deals in a row. It's not how we like to do things. But yeah, they came in. They drove a hard bargain, but you get to do that when you are providing a big check. And but they were great to work with. We got it done, and I'm looking forward to working with them for the next 5 years or so.
Awesome. So tell us about the syndicated portion. Well, let's talk dollar amounts if you can.
Yeah.
$10 million senior debt position. How much, the rest, did you raise just 7 million, or did you raise a little bit more for like operational and CapEx reserves?
Yeah. So we raised, I want to say, a little north of $7.5 million. We had a $5 million JV position that came in. We have a pretty significant CapEx budget because 90% of the units are unrenovated, and we also have that vacant office that I previously mentioned. So we've got a lot that we want to do. We think there's a lot of ways we can improve the property. Another thing I liked about the property that I didn't mention earlier is it's not the newest property in the market. There's a newer property that was built in 2012, has the highest rents. And typically if you're more rural or just in general, it's always nice not to have to lead the race. It's nice if someone else is setting the benchmark for the highest rents in the market. So we had another group we could draft off of. If they're charging 1,500, we could charge 1,400. And the other property called West Point, this is the newest asset in the market. They were doing value add renovations as well. So, we see them, their rent's already higher, they're doing value add renovations. That just made it easier to draft off of them. Sorry, a bit of an aside. But yeah, that was yeah, we had the JV for roughly 2/3 or about 5 million of the 7.5 plus, and then we syndicated the rest of it, circling back.
Mm-hmm. Well, just a comment to your aside is I think that's smart, right? Like, we're seeing a lot of newer operators that are coming into the space, and they're trying to assume these crazy like rent increases and trying to be the leader in the market, which is really hard to do. So if you're in the position, that's another way to kind of de-risk the deal, is if you're not the top rent setter in the market and you can do what you said, kind of draft. So I do like that. So for your limited partner investors, what kind of returns did you provide to them? What did you do? A preferred return, splits, any IRR hurdles here?
Yeah, so I want to say we actually went really high on this one because of cash flow. I think we had something like a 12% preferred return on this, which was the highest we'd ever done. Um, yeah, no, it was very interesting. We like I said, our JV partner came in and they said like, hey, we want a pretty high hurdle. We said, yeah, we'll match that. And we were partial part of our thinking was we don't want to upset any of our other investors by, saying, hey, look, you're getting this, but these guys are getting this. So we just raised it up, put them in a better position. Overall, I think we were offering the projected IRR was maybe a little shy of 20%, 18 to 20% project level IRR over a 5-year hold. Very strong cash flow, like we mentioned before.
Awesome. And what kind of fees did you charge the deal?
So I think we had I want to say a typical maybe 2% asset management fee, our acquisition fee. There were a few fees involved, equity placement, asset management, or acquisition that totaled about 2% of the purchase price. So fairly standard.
Okay. And any disposition fee?
I think there's a 0.5% disposition fee, but that's it.
Yeah. And what's your overarching game plan? Is it to, increase the income on the property and refinance, or, or are you looking to sell?
So the plan we pitched was just we want to go in there and we just want to operate the property. Don't rock the boat was the big theme. We're not going to go in and say we've got to renovate 50 units a year for the next 2 years. Like let's churn, churn, churn. We wanted to go in there and just keep it steady. When units become available, let's renovate them. We're not going to be, lackadaisical about it or anything like that, but it's a strong cash flowing asset. Let's keep it that way. Let's deliver distributions to our investors. Let's keep everybody happy because it's increasingly, a lot of multifamily out there is not in a position to do that just because they're getting swamped with floating rate debt that used to be at 4 and now it's at 9. Or even if they have a rate cap in place, they have to put a bunch of money aside to renew the rate cap. Otherwise, they're going to be forced to sell. So our huge goal is just let's operate it, let's cash flow the property. We're going to improve it. We're going to, make it a nicer asset, but we really just want to make sure we're delivering constant cash flow to our investors.
Awesome. Well, Will, I just have 2 questions for you before we wrap up. What did you find easy in this process that you thought was going to be a little bit harder? And what actually ended up being harder that you thought would be easier?
Well, I'll start with the harder part. I mean, the environment, the equity raising environment is understandably a little rockier than it has been for let's say 2020 through 2022. A lot of investors you talk to, they're holding on to money because they're working with somebody else or they have another project. They're worried about a capital call. So the equity market I've found is a lot cooler than it used to be. And the loan assumption process, never fun. Never fun. First time doing that. I've heard the horror stories, and yeah, it was not a fun time. As far as what was easier, I mean, almost anything was easier compared to the loan assumption. I mean, the seller was tremendous to work with. The property performed absolutely great. The financials, they all checked out. There was no funny business anywhere. So the due diligence process, all that, it checked out really nicely. Very straightforward acquisition, except for that pesky loan. But look,
I
for
would
3.32%, I'll jump through a lot of hoops.
Exactly. I was going to say that it might be a hot pokers under the fingernails, but for to get a loan like that and a performing property like that, I mean, that is a solid deal. So,
8 months of
well,
work for 8.5 years of that interest rate. I'll take it.
exactly. Well, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to find out more and connect with you, how can they do so?
So I'm pretty easy to find on LinkedIn. Will Matheson. I'm at Matheson Capital. They can also visit our website, mathcap.com, or they can email me directly at will@mathcap.com.
Awesome. Well, thank you again for sharing your time and expertise with us here today. We look forward to hearing about your future deals.
Thank you for having me again.